Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Microsoft. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Callie Cox, Senior Investment Strategist for Ally Invest.
Well, Callie, I have a graph of the S&P 500 index. We set an all-time high once again today. What do we see going on in the markets throughout the week?
Yeah, Brian, well, you're right. Stocks are up a little bit today. That would be the third straight record high for the S&P 500 if we close at these levels. And the market is just quietly charged higher recently. Quietly, or maybe not so quietly. The S&P just posted two straight record highs on 2 days of gains greater than 1%, which is only the second time that's happened in 20 years. So we're seeing a lot of unusually high buying interest at these record highs. Kind of more of the same, though. That's been the story for most of this year. And there are good reasons for that, too. Economic data is starting to blow estimates out of the water again. We just saw a huge March jobs print on Friday, and we saw a record high ISM services activity reading. And I look outside, I've got a nice new window beside me right now, and I'm seeing signs of spring here in North Carolina. The temperatures are climbing, the flowers are blooming, my sinuses are clogging. So excuse me for the voice quality if my voice cracks. So we're just seeing a lot of green shoots in life and in the markets. And I'll add too that April is a historically strong month for the stock market. Since 2000, the S&P has gained an average of 1.7% in April. That's its strongest monthly return over that period. So the stock market tends to like the springtime too. So everything's going well. The stock market's at record highs, but I'm going to throw a little plot twist into this story. Stocks keep pushing higher, but we might actually be transitioning into the next phase of the bull market with this pandemic, hopefully ending in the next few months. A lot of this rally, as you know, and as we've talked about for months now, has been driven by hope for the future. But now that we're officially at that point in the future that we've been waiting for, and growth is starting to boom, the market may be looking for what's next and taking cues on where to go. And chances are both economic data and earnings won't be beating expectations so handily for much longer. And I'll add too that we still haven't seen a significant pullback in this recovery, which is a bit unusual if you look at past bull markets. So it's just something to think about over the next few months. Humor me a little bit here. For now, stocks seem to be marching higher. But over here at Invest, we are turning a little more cautious and skeptical. Maybe it's time for investors to start lowering their expectations. And we're not calling for market doom and gloom. I think we're just, calling for more of like a summer, kind of pause, stay in place, figure out where we're going to go next type of market. Although I will admit, it's really hard to say that with the market momentum we've seen recently. By the way, our chief investment strategist, Lindsay Bell, explains a lot of the argument for caution here in our Q2 market outlook, which should be out later this week, shameless plug. So definitely check that one out. So yeah, Brian, it seems to be, business as usual, and we'll see what's going to happen in the summer. I have noticed that the VIX keeps pushing lower these days, which could be a good sign for stocks. So tell me about what you're seeing in options world.
All right, Callie. Well, I am sharing my VIX watch list that we've been talking about weekly here on the Stock Play of the Day. And we do see that the VIX is basically flat today. It's at 1792, which a flat VIX is pretty good considering that we are below that 20% level. And it looks like we're setting new ground in the VIX since the March lows of last year. So if I look at my VIX chart, I actually see that 20 level was a big level. We're now hanging out quite a bit below, a couple percentage points below, seeing the VIX, south of 18% right now. But more importantly, when I look at the futures contracts, I'm looking out to April, only a couple of weeks before that expiration date in April, and we see that below 20. And then the May VIX future is right around 21 and a half. So if I go all the way out, and I actually don't have these quotes on this platform, but I look at the Chicago Board Option Exchange futures quotes, which go as far out as January or December, I should say, of this year, we see that the VIX index on the futures quotes are all below 25% currently at the moment. Now, it took forever for the futures contracts going out that far in time to break below the 25 level. So that's just showing a little bit less nervousness, a little bit more confidence in these new highs that we're seeing in the S&P 500 indexes and also in other indexes just in general. So overall, I would say that's a good sign for the marketplace, but it's just one data point. Okay, now last week we looked at the QQQ, and I want to highlight this chart just because it's a pretty dramatic look at the breakout in the QQQs. This is exactly what we were looking for last week on the stock play of the day. And you see here that we had many areas on this channel trend line that were being touched, and we're having a lot of problems breaking through that to the upside. But when we did in the QQQ, we broke through very strong. And right now, we're having a solid move in the NASDAQ stocks overall, or tech stocks if you'd like. And hence one of the reasons why we're going to talk a little bit about Microsoft today. So if I look at the Microsoft chart, and let me scroll this down a little bit here, we also see in Microsoft that we had a strong breakout to the upside, and we're maintaining that. We got a couple of big green candles here in Microsoft. Looks a lot like the QQQ, except for the fact that we're just breaking through on new highs on the Microsoft chart, as opposed to the QQQ, where we haven't actually set a new high over the last few days. So with Microsoft breaking through to the outside, looks fairly good on a charting perspective. What do you see going forward in Microsoft, Callie?
Yeah, Brian. So let's talk Microsoft. So we all know Microsoft. It's one of those big tech stocks that doesn't get as much attention as the FANGs, the Facebook, Apples, Netflixes of the world. But it's still the second biggest stock in US markets. And like I said, it's a tech stock, obviously. So it has good brand recognition, but it's not as much of a momentum play as the FANGs, which makes it kind of an interesting play right now. It's a little too early 2000s for some investors' tastes, but I have good news. The early 2000s are back, baby. And Microsoft could be poised to lead the tech space higher, at least over the next month or so. So here's what I'm seeing, and here's why I think that could be the case. So tech may be rebounding right now, and that's obviously great for Microsoft, but let's look at the fundamental picture first. There's still an obvious preference for quality in the stock market. And Microsoft could be a good mix of momentum and quality. It's an established company with lots of cash on its balance sheet and healthy rates of free cash flow and earnings growth. It also has stakes in hot tech trends like virtual reality, for example, and reports say that it could be eyeing an acquisition of Discord, which would give Microsoft a stake in the hot esports gaming industry. Plus, it could also be a big beneficiary in the shift to remote work as companies start to upgrade their IT infrastructure and revisit their cloud and security solutions. So sure, the 2000s are back, but today's Microsoft is vastly different than the one we saw 20 years ago. It's a good hybrid of an established name with lots of exposure to more innovative spaces. And Wall Street really likes it too. Analysts expect Microsoft's stock price to rise nearly 12% over the next 12 months. It's got momentum on its side as well, as you mentioned, Brian, and we can't ignore that. Microsoft is up nearly 7% in the last 3 trading days, along with a pretty big rally in tech. And it just broke out to a new all-time high, which I know looks good from a charting perspective. So much of this rally, came from a headline a few days ago about Microsoft winning a $21 billion contract to provide augmented reality headsets to the Army. And that sentence in itself, I think, is a really good reflection on where Microsoft is. We're talking augmented reality, but providing business to more established, more established entities like the Army. But I will add that we are feeling a little cautious on the tech space here. And for every good story, there's always like a little plot twist that you need to consider. So if the market does decide to take a little breather here, like I was talking about, Microsoft could get sucked in if tech falls again. Maybe not as much as the Apples and Teslas of the world, but it could be exposed to another sell-off if we see investors turn away from tech names for sure. But we'd expect any sell-off in Microsoft to be a buying opportunity because Microsoft's long-term story looks pretty enticing. So to wrap it all up, Brian, we're feeling pretty positive on Microsoft long-term, and short-term, it could have momentum on its side. So I want to see a paper trade that reflects that. So before I pass it over to you, Brian, I want to remind our viewers to please toss some questions in the chat. Brian and I like a good challenge, and we're definitely happy to talk anything markets and Microsoft and options, although I might pass this to Brian. So anyway, Brian, take it away. What are you seeing in Microsoft options?
All right, so let's start by going to the options playbook. The strategy we're going to look at today is a long call spread. Now, as always on the options playbook, this is not meant to be a recommendation. I should say on our strategy, it's not meant to be a recommendation. And we've talked a lot about if we want to get long some of these underlyings with limited risk, we were calling them FOMO trades. And one of the trades that we've been looking at a lot on quite a few of these stocks while we've had the bull market is buying leap options or longer term options as a substitute for buying the stock outright. Today, I'm going to build this strategy as a similar type strategy. We're going to look at a long call spread, but we're going to go out further in time. A lot of times when we're looking at long call spreads, we're doing them in the short term because one of the biggest things about a long call spread, which we see here in the options playbook, is that we'll be buying one option contract that wants the market to go up, and we'll be selling one option contract that wants the market to go down. So they fight each other. And because of that, long call spreads will usually max out closer to the expiration date. So when you go out further in time, it slows down the rewards if you're correct on your forecast. But then again, if you go out further in time, it gives you more time to be correct on your forecast. So it's a little bit of a catch-22. So a lot of times when I'm looking at long call spreads, I'm going to be speculating on something. Maybe implied volatilities are kind of high. So I'm going to look at buying an option contract and selling one at the same time. Buying the more expensive option contract, selling further out of the money, the less expensive option contract. Trying to battle either fluctuations in implied volatility or maybe time decay. Now, Microsoft in general is a fairly expensive stock. It's a $248 stock. It's not like an Amazon, et cetera, but it is an expensive stock overall compared to the rest of the marketplace. This adds premium to your option contracts. It's not trading at a bad implied volatility. It's right around 24%. We got the VIX down around 18% to give you to compare relative to the actual S&P 500 index. So it's not trading at an outrageous volatility, but we do got to be aware of the fact that we are coming into earnings season on all of the stocks. And the next anticipated earnings date is going to be May 5th for Microsoft overall. Okay, so little bit, we've got a breakout in some of the tech stocks. They've been the laggards in the marketplace, the NASDAQ in general, even though during the pandemic they were leaders, now they're laggards overall. Well, how could we take a position in a stock like Microsoft without all the risk of owning the stock outright, but giving enough time for our scenario to play out? We're going to look at the long call spread, and we're going to go out till June, 73 days away. A little bit longer than I normally would on a long call spread, but I have a different outlook for the underlying stock. So because of that, we're going to go a little bit in the money, and we're going to pay a lot of attention to the amount of time premium we are buying versus the amount of time premium that we are selling. So in this instance, we go down to the 240 strike call. Stock is at 248.77. Now, these quotes are live. We always tape live here on the stock play of the day. So that's a fairly expensive option contract. We're looking at 1540 by 1560. Now, this is a good, a very liquid underlying, which helps when you're buying deeper in the money, longer term option contracts. So we're okay with the market as far as buying the option outright. But we're going to actually sell the same expiration against it. We're going to go out and sell the 270 strike. That's going to be a 30-point wide spread. That means the maximum that the spread could trade for would be 30 points. Now, when we look at the 240 strike, I'm going to take a peek over here on the right-hand side and look at the value of the put. That put option is trading, let's call it $7. Well, $6.90 is the midpoint. That means that we're buying a fairly decent amount of time premium on our option contract. And I'm going to try to cut that in half. And that's why I'm selling the option contract against it. So if I look at the 270 strike, we see that's trading for $3.15 by 325. We'll call it 320. So we're getting about half of that time premium back by selling this out of the money option contract. Now, the downside is that if we're correct on our forecast, we need some time decay to happen on that option contract overall in order for this strategy to max out. And that's highlighted by scrolling down and looking at our profit and loss graph down at the bottom of our option chain. So if I see this, as of today, the colored line highlights our profit and loss if we put the trade on right now. This is where our break even would be at relative to the stock. It's wherever we cross the actual x-axis. And as we approach expiration, or I should say approach our short strike, we'll see to start with, we're not getting a lot of reward. Because why? We have a lot of time premium. We need some time decay. If we are correct and it goes up to 280, we're going to do a little better. But let's take some time decay. Let's say it takes half the time to get there. Now, you'll see this drift towards that dotted line, which would represent the expiration date. So let's go down to 30 days remaining to expiration and regraph. Now we're a little tighter. If we get up to 280, we're actually coming fairly close to making the maximum. Now we're going to go down to 5 days to expiration, and boom, now we're basically right at the dotted line as expiration approaches, highlighting that, yes, we need time decay to happen if we're correct on our forecast by doing this long-term, and I would call this long-term, it's 73 days out, long call spread. Now, if I was just buying options outright, I wouldn't think that this was a long-term, I'm putting that in quotations, option contract, because if I'm buying individual options, I can err to the side of buying too much time. All that does is increase my overall cost, which means it increases my overall risk. But if I'm correct on my forecast, I would like it to happen sooner than later. But if I buy a long-term option, I have a slower rate of time decay. In a long call spread, I need some time decay if I'm going to be correct on my forecast. So there's a little bit of a contradiction. I haven't talked about a long-term long call spread as a way to reduce your risk in the marketplace, but still allow you to participate in some upside movement in Microsoft. So I'm billing this as a FOMO trade in that we're not going to buy that deep in the money option contract. We're going to do a long call spread. But if I was thinking about buying 100 shares of Microsoft, I'm still going to limit my risk. And what I'm going to limit my risk to? The net debit paid here. So to officially make this the paper trade, I'm going to put it in the right rail. And this would be done for a net debit to the account. So this, in our test account here, we're going to be buying the June 18th expiration 240 strike call, the in the money call, and we're going to be selling the June 18th expiration 270 strike call. So it's right at 1250. That makes the math easy here. So that means we'd be risking $1,250. Now, 12.5 points in Microsoft. Could we lose that if we bought 100 shares or that $1,250? Yeah, that could happen fairly easily on a $249 stock if we bought the share outright. But by doing it using a long call spread, that is, we know 100% that that is our risk out until that expiration date via the option strategy. So once again, if you kind of looking at what we talked about last week in the breakout in general, in the NASDAQ stocks. And then we have another breakout in Microsoft. This is kind of playing off that event. And we still have some nervousness in the marketplace. So this is one way to take a position on Microsoft, looking for a little bit more upside going into the summer months. We're going out to June, 73 days away, and hoping that we got a target of Microsoft reaching 270, which is a feasible move. We're talking about approximately 7% move, 7 to 8% move to the upside in order to get to that strike. All right, Callie, a little bit long-winded on my strategy, but I felt the need to kind of highlight the fact that we're still treating this as a FOMO trade, fear of missing out. Do we have any questions that we can address in the chat box? And now is the time. If you have not submitted your question, please put it in the chat box and we'll try to answer it live here on the stock play of the day.
Yeah, for sure, Brian. And I know we have a few questions, so let's get to those. By the way, if anybody has questions about UNC basketball and the coaching search, I'm happy to address those too. That's been on my mind way too much lately. All right, so we have a question. One popped up. I was like, oh man, somebody took that seriously. Okay, we have a question from Wayne. Hi, Wayne, longtime caller. Hey, Callie, North Carolina is beautiful. Time to get outside. I agree. The pollen is ravaging my sinuses, but it's 75 degrees and I can't complain. And he asks, Brian, isn't a higher VIX better for us as options traders since it creates volatility crush and more selling opportunities? And I'm actually going to add a part 2 to that, Brian, because Wayne also asks separately, also, when would you take profits on a leap or longer call position? If you hit 20 to 30% profit in the first week, would you close the position or would you continue to hold? So 2 questions for you, Brian.
Okay. Well, to address the VIX, I think the VIX in general being higher makes option strategies easier in that you can do some fancy stuff because there's enough premium in the markets to be able to adjust trades and able to get on trades for a decent dollar amount. Specifically, we've talked a lot about in our midday market call, which we do every Monday on our Zoom platform. We talked about buying long call spreads in the S&P 500 index, buying long butterflies. They're cheaper when the VIX is a little bit higher, specifically on butterflies overall. But with that said, each market is different. So you just adjust your strategy accordingly. I don't think that there's any good or bad as far as where the VIX is at. It just means that this one particular strategy might not be what you choose because the VIX is at 10% versus the VIX being at 20% overall. So you just always address, there's no golden book of answers as far, you take what the market gives you and then you adjust your strategy accordingly. All right, so now if you hit 20 or 30% in a week, yeah, why not take a profit? One of the biggest things about option trading is that you do have an expiration date. The concept of buying and holding for 5, 10 years doesn't really work out in the option trading world. So the biggest thing is to have a plan. And if you're putting on an option trade, you should make up in your head exactly what am I willing to take on the upside, where would I like to get out, and where would I like to get out on the downside. I almost always, if I bought a longer term option contract, go on out and let's say we just bought this Microsoft Leap and we made it the 73 day, we just bought the call outright. I would put a limit order in to sell to close that at wherever that profit might be. According to Wayne's text, it might be 20 or 30% higher. I just leave that order in there just in case it sneaks up there and gets there. I don't mind getting out. Why? Because it's a decaying asset. Overall, that there is going to be an expiration date and I'm going to have to do something at that expiration date. So I usually have a target to the upside and a target to the downside. Now, with a long call spread, my target to the downside might be what I paid for it, right? $1,200 versus $250 stock, a $25,000 investment on 100 shares of Microsoft. I can handle the $1,200 if I look at it relative to that. So on my downside, by doing the long call spread, it might just be the net debit that I paid for it. But on the upside, I need a number in my head and I need to target that number overall.
Good answer, Brian. Very thorough. All right, so we have a question from William Mitchell. Hi, William. William Mitchell has more of a demonstration kind of question. He asks, can you demonstrate on the Ally Invest platform how to A, set an initial stop when placing an options trade, and B, adjusting the stop as it moves?
Okay, I see it over here. A, set an initial stop when placing an option trade. Now, as far as option trading is concerned, I can't set an initial stop price on an option trade inside the Ally Invest platform. And stops are always tough in options because the market is so wide, right? So, for example, here I'm looking at the Ally Invest workbench right now. Ally Invest workbench right now, and we see the net bid is 1210, the net ask is 1250, the midpoint is 1230. So, if you put in a stop and you sell it at market, you're talking about giving up 40 cents between where the ask price is and where the bid price is on a $12 or $1,200 investment, $40 overall. So stops are tough. So I always want to look at it and see where the market is at. And I might set an alert basically on the stock price. One of the biggest things that I've always talked about when even doing long-term option contracts or a spread like this, if it ever gets to my strike price of the option that I own, I'll consider getting out of the trade at that point in time. Why is that? Because time premium collects on the most at the money option contract. So if it came down to the 240 level and I was trying to manage my risk, that would be a price that I would target. That would be a price that I'd want to set an alert at and look at what is the call spread at and reevaluate my strategy on Microsoft overall. All right. And I think I need I'm going to take a sip of water here. And next question.
That's when you know you've stumped Brian. He has to stop for water. All right. So we have a good question from Gabe Robinson. Hi, Gabe. Gabe says, you mentioned earnings season coming up, and we did. Microsoft earnings do start or are reported on April 29th. Generally, how far from earnings season is a good rule of thumb to avoid an implied volatility crush after earnings? And I'm actually going to take the first part of this question, Gabe. So as I mentioned, Microsoft is reporting earnings on April 29th. S&P 500 earnings season starts on April 14th. I know I'm rattling off a lot of dates for you, but here's kind of how I think about it in terms of like market moves. Obviously, when you're looking at one company and they're reporting earnings, generally you see that reaction pretty quickly, right after they report earnings or the day after if it's post-market earnings. If you're looking at like maybe a set of companies like in an ETF, or if you're looking at the whole S&P 500, many bigger S&P 500 companies do report in the first month of earnings season. Like I said, Microsoft is the end of April, and I mention the FANG stocks all the time, but a lot of the FANG stocks report in that third to fourth week of earnings season too. So generally after the first month or so, earnings reports seem to trickle down a little bit. And the earnings move likely has already been made in the S&P 500. The market starts catching up to what the general themes are in earnings reports. But I'm going to pass this question to Brian because he probably has some option specific thoughts on how, or like the timing around, playing a company earnings in options. So Brian, I want to hear your thoughts on that.
All right. And we're running out of time here, so this will be our last question in general. But with that said, around earnings, it's part of the reason why why I chose a long call spread today is because we are coming into earnings. I'd be a little nervous if I was just buying the leap outright, because I have a longer term outlook for the underlying stock, and I would be paying a little bit of inflated vol premium because of that earnings date on May 5th. It's a month away. But ideally, if I'm doing these type of strategies around earnings, you really start to see the vol pump up about 2 weeks before and a lot in the very last week going into that earnings. So those are the areas where I'm a little bit nervous about putting on an option strategy. And if I do put one on, I want to be aware of it. So for example, today we're doing a long call spread because of earnings, and not necessarily 100% only because of earnings, but it is a thought. It's something that's out there that's staring us in the face, as opposed to just buying a long call option outright. So it does play a factor. You always want to be aware of it. And that's why on the Ally Invest option chains up by the quote, we always highlight where that earnings is, and you just want to be aware of it and choose your expirations wisely because of that earnings event.
Yep. Good point, Brian. All right. Well, as Brian mentioned, we seem to be out of time. It's 12:30. Buzzer's going off. So thank you for joining us today. Thanks for letting us walk you through our thoughts on Microsoft in the market. There will be no stock play of the day overtime on Friday. We're taking a week off, call it a spring break of sorts. So definitely tune in next Tuesday because we'll be back with another cool stock for you on the stock play of the day. All right, Brian, take us out.
All right, everyone. So to make sure you get all the alerts, you want to click subscribe and ring the bell, and we'll see you this coming up Tuesday for the next stock play of the day. Thanks for coming, everyone.